Double bottom chart pattern. In this video you will learn what a double bottom pattern is, how the pattern is formed on a price chart, and two common ways to trade the double bottom pattern. The double bottom is a reversal pattern that is found after a downtrend. It is the inverse of the double top pattern, which occurs after an uptrend. After spotting a double bottom pattern on your chart, you would be looking for potential buying opportunities. Let us look at the construction of a double bottom pattern on your chart. After a downtrend, price finds support and the buyers come into the market, overcoming the sellers. This rally finds further selling interest as the trend is still down and gives the bears an opportunity to get in at a better price. Price finds support for a second time, where the bulls come in and overpower the bears, causing price to rally. This gives the double bottom a structure of two distinct lows on your chart, where price found support after the sellers were overcome by the buyers. The pattern gives the resemblance of the letter W on a chart. The center high of the pattern is referred to as the neckline of the pattern. This level is monitored by traders as price needs to break above this level before the pattern can be qualified as a double bottom. Now that we know how the pattern is formed and what it looks like on a chart, let us look at two approaches to trading the double bottom. One of the more common ways traders look to trade the pattern is to enter a long position after price breaks and holds above the neckline of the pattern. Waiting for a candle close above the neckline confirms that the bulls are in control and that price is likely to continue higher. The stop loss would be placed below the low of the pattern, under support, and the profit objective is simply calculated by measuring the height of the pattern and extending that measurement up from the neckline. The second and more conservative way traders like to trade this pattern is to wait for the price to trade above the neckline, which is also viewed as broken resistance. They would then look to place a buy order on the retest of the neckline, which would now act as potential support. Remember, once resistance gets broken, it is likely to become support. The stop loss would go below the new support area, and the take profit would be measured as in the first example by taking the height of the pattern and extending this measurement up from the neckline. Remember that the double bottom pattern is a trend reversal pattern, and as such, it should be looked for after a downtrend has been established. So far, you have learned that the double bottom chart pattern indicates a possible move up in price and offers a potential buying opportunity. You can trade the pattern on the breakout of the neckline, placing your stop loss below the pattern. The profit target is calculated by measuring the height of the pattern and extending that measurement up from the neckline. You can also trade the double bottom after the price has broken through the neckline and retested it as support. The stop loss goes below the support level and the profit target is calculated by measuring the height of the pattern and extending that measurement up from the neckline.